I can plan and I can create all the components I need for a successful flight. Well, if I'm building a company and I'm growing from a certain size, from one size to another, people is a large component of this. Companies don't grow because I will it or wish it. I start by building a very strong culture. I need to build some kind of a shared alignment. I am going to reward those people that help us achieve this plan, and I'm going to make them a part of the success. When I have those things, I can be very transparent as a CEO and talk openly about revenue growth, earnings growth, and what it means to each of the people.
Welcome to the Strategic Planning Room, the place where senior leaders step back from the noise of execution to talk about what really drives long-term success: clear thinking, intentional strategy, and meaningful planning. Too often, strategic planning gets reduced to slides, spreadsheets, and annual rituals that never quite translate into results. But today's guest has spent more than 2 decades proving that when planning is done right, it becomes a force multiplier for growth, culture, and value creation. Our guest today is Adam Coffey, CEO, board member, best-selling author, private equity value creation leader, and one of the most accomplished operators in the service economy. Over 25-year career as CEO, Adam has built and scaled multiple platform companies, completed 58 acquisitions, and delivered outcomes measured in the billions of dollars for investors and teams alike. Adam is also the author of the Private Equity Playbook, the Exit Strategy Playbook, and Empire Builder, all #1 best-selling books on Amazon, and a sought-after advisor to private equity firms, founders, and future leaders. Today, we are going beyond the headlines and the playbooks. We are talking about how strategic planning actually works in the real world, how leaders create alignment under pressure, and how planning done with intention can create not just returns, but meaning. Let's step into the strategic planning room with Adam Coffey. Thank you so much for joining us, Adam. Truly, truly appreciate your time.
Well, thank you for having me. It's very good to be here, and hello to all your listeners out there.
Awesome. So the first question that comes to mind is that you've led companies through billions in value creation and 58 acquisitions. When you look back, what's one strategic planning decision that fundamentally changed the trajectory of a business you led?
Well, let's start with my own personal trajectory. So, working as an executive in the Fortune 500 world, telephone rings. This is back when we used to answer them. Recruiter, trying to get me to leave GE and go be a CEO for the first time of a company that happened to be owned by a private equity firm. And so trying to understand, I had no idea what private equity was back in that time period. Private equity was an established industry, but it was rather nascent in size. There was less than $1 trillion in assets under management at the time. There were around 1,400 firms in existence. Roll tape forward, depending on which source you read, private equity today is anywhere from 7 trillion to 19 trillion in assets under management, and they're buying and selling 50% of the companies bought and sold on the planet. So the industry has exploded in the time period that I've worked with it, and so I've been able to see that change actually happen and take place. when I think about your actual question, a time, a place, I always think about my life just in terms of these different inflection points. I was a soldier in the U.S. Army, leaving the military, going, leaving, a good career to head there. I then became an engineer, leaving there to go take on as a business leader, being in Fortune 500, working, in the Jack Welch era at GE, and then leaving there to go be a CEO. So, I can point to defining moments in every company or in every job that I've held where my career was at a crossroads. And companies are no different. So if I look back at every company that I ran, they started as a turnaround. And so I was a turnaround expert within GE. That was kind of how I got typecast early on when I finally worked my way into management at GE. And all the companies that I started running were all essentially turnarounds. So they were underperforming companies that had been in business for over 40 years before I got there. And in every one of them, there's a myriad of strategic decisions that have to be made. In the initial immersion in the company, I'm evaluating the leadership team. Do I have the right team? Do I have the right team in the right seats on the bus to execute the vision, on a go forward basis? So it's decisions being made around people at first, and these are pretty monumental changes in direction when you're walking into a company that's not delighting, and you're quickly evaluating, could be as many as 12 to 14 people to say who stays, who goes. I'm here to win a championship. Do I have the team that can execute? And so making those kinds of decisions, and I literally, in one company, the turnaround was so bad that I'm sitting there wondering, am I actually going to put chains on the door, and is this company going to fail? Or am I going to succeed? I remember walking into a boardroom with my leadership team and saying, we're not walking out of this room until we find X million dollars in cost reductions, or we're dead. Game over. We're not making payroll next week. So all kinds of decisions that collectively I've made hundreds of decisions that I would say had a great impact on whether or not a company was going to succeed. And did I make every one of them correctly? Probably not. I'm sure I made every mistake in the book, which is why I wrote the book, was so that your listeners don't make those same kinds of mistakes. But I care about people, and I believe in building strong cultures. And I think to build a successful company, you must have a strong culture. If you're going to attract talent in today's market, you're going to have to be a transparent leader who cares about people. You can't mail it in when it comes to your thought around employees and building culture in a business. So yes, many decisions made, hundreds of decisions made in any company. Many of them could be controversial. You're relying on training, you're relying on intuition. And as I got older in life, I'm also the multiple reps being a CEO. Multiple times I've faced difficult decisions, and how do I make that decision today may be colored by previous experiences where I had to make tough calls in the past. But it's probably not as direct and short an answer as you'd like, but there was a lot of things popping in my mind when you asked that first question.
But that's a great answer. And if I boil it down to the core of my understanding of your answer, strategic planning decisions, the most important part of those are the decision makers themselves.
Yes.
Sometimes you
But
can
matter of
plan
fact,
the
I'm
best
going to
way.
go back to World War II, and I'm gonna talk about the Battle of Midway, and Admiral Halsey, who was supposed to lead the U.S. fleet, was laid up in the hospital, and so he had to select someone to replace him in the battle, and he chose a captain who had never commanded an aircraft carrier before, or an aircraft battle group before, and and it was Admiral Spruance, and Admiral Spruance asked him, "Are you crazy?" It's like, I've never done this before. What if I don't make the right calls? Admiral Halsey said, when in command, command.
Mm.
Make those tough decisions. Don't worry about what other people would do. So where was I going with that? I would just tell you that oftentimes there are decisions that need to be made, and indecision is what kills a company. And not making a decision, not being able to go left or right, just standing there frozen. And oftentimes I would tell you, Jack Welch once told me, a mediocre plan, well executed, will deliver so much more in results than an overly complex plan that never sees the light of day. So sometimes we have to get on a path. We have to make a call. We have to make a decision. We're at a crossroad. When in command, command. Make that decision.
Yeah, that's a great advice. Indecision sometimes can kill businesses, for sure. And to the CEOs watching today, and if they who believe that they are too busy executing, but don't sometimes pause and take a step back to plan and reflect, what would you tell them?
There's a really interesting study that was done by Harvard Business Review. And if your listeners just simply Google Harvard Business Review time management study successful CEOs, it'll pop right up. It's in the public domain. And going back a long way, but it was interesting because what Harvard did in this survey, in this study that they did, they didn't try to figure out why someone was successful and became a CEO. They just said, hey, you are a CEO, big company. Let's look at your calendar. Let's look at how you schedule time, and let's see if we can find any correlations between success and how a CEO manages time. And I think for me, one of the shocking results of that was that a successful CEO may schedule as much as 25% of their time alone. Time to be reflective, time to be strategic, time to focus not on the problem of the day, but on, just call it, the strategy and direction of the company. So up to 25% of a successful CEO's time calendared to be alone, to be strategic, to think, to pull themselves up off of the chessboard, and instead of being a pawn on the chessboard, looking at the entire chessboard to figure out what the next moves are going to be. So always, so many people are so busy being busy that they never pull back and take time to be strategic. And I always tell people, as a CEO, if I've done my job correctly, I have literally no job to do. If I have the right team on the field, the right people in the right seats on the bus, if I have the right vision, the right strategy, and that team is executing, I call myself a lazy workaholic. I work hard so I don't have to work hard. If I have the right team, if they're empowered, if the vision is good, the strategy is good, the measuring systems are good, and that team is executing, there's actually very little for me to do. So being strategic, spending time, charting the course, and think of it like this. If I can use an analogy, consider a company as a cruise ship out in the ocean. And the captain of the ship is on the bridge, and the captain needs to be on the bridge to chart the course, to see where the ship's going, to plan where the ship is going. And if I don't have an effective leadership team below me, and I'm spending too much time off the bridge, down below decks in the engine room, because my leader running the engine room isn't doing a good job, I'm not up on the bridge, I'm not being strategic, and that's when ships get into trouble. If I have the right team, if that team's empowered, that leaves me free to be on the bridge, to chart the course, and to be strategic. The weather conditions may change, but I have the time that I need to be strategic about where that ship is sailing. So, if you think about EOS and you think about continuous improvement and Six Sigma, Lean Sigma, and all these things, all of these types of processes and programs are designed for me to have a better ship. but none of them tell me where to sail the ship. They all help me build a better ship, and a better ship does good in a bad storm. But it takes a captain on a bridge to chart the course, to determine where to sail that ship. And so I think that for CEOs out there, spend less time in the minutia, spend more time being strategic. You should be spending up to 25% of your time alone, being strategic, thinking, where is that ship sailing next? And building the team of people who are going to be responsible for the keeping the trains running on time.
Yeah, that's an amazing advice. Thank you. And you've led service businesses across multiple industries and ownership structures. How does your approach to strategic planning change or not change as companies scale from founder-led to PE-backed platforms?
Sure. So, first of all, let's just talk about the need for planning in general. So I'm a pilot. Pilots don't take off unless we know where we're going. And once I know where I'm going, what that destination is, I can deconstruct the trip. I know how much fuel I'm going to need. I know what my flight plan and route is going to be. I can think about what alternate airports might I go to if I have trouble. What's the weather going to be like en route? What are the winds aloft going to be? I can think about all these different variables, and they all come into play and they become so logical if I know where I'm going. And one of the biggest problems that I see with founder led companies is there is no destination in mind. They took off, but they don't know where they're going. And if we don't know where we're going, how do we know when we've arrived? How do we know when we've gotten there? How do we know when it's time to change behaviors or to do something different? And so CEOs take off all the time and they have no destination in mind. In the world of private equity, there's a 5-year timeline. There's typically a 5-year hold period. Could be a little longer, could be a little shorter. I think I've run companies for as short as 3 years, as long as 7 years in one hold period. But clearly there's a destination in mind. The PE firm bought the company. They have a very finite amount of time to triple the earnings of the company or quadruple the earnings of a company, typically a 5-year hold period. Now that I have the destination, now I can deconstruct the trip. How big am I today? How big do I need to be at exit? And there's really only 8 levers of growth, when it comes to earnings in a company. I've got price, volume, pivot, tiering, in margin improvement. I'm looking for high volume work and low value work, and I'm wanting to automate, outsource, eliminate. And then I have mergers and acquisition as the great filler. I'm baking a cake. I've got 3 ingredients. I'm trying to raise revenue. I'm trying to decrease cost of servicing revenue. And then I've got mergers and acquisition. And these are the only 3 ingredients that I've got to build my cake to take me from where I'm at today to where I need to be in 5 years. I'm engineering the exit. In a founder-led company, I don't necessarily have to exit, but I still need the interim destination in order to plan. I'm a big proponent of strategic planning. I think partially it's the engineer in me. Engineers don't do anything without a plan. And there's 1,000 steps, and we do step 1 before we do step 2. And, the world can throw us curveballs. The Great Recession, planes flying into buildings, wars, pandemics, all kinds of things can happen that might cause us to have to adjust or revisit that plan. I take that as I've taken off, I was heading and bad weather popped up and now I have to deviate. But I'm still going to get back to my flight plan. I'm still got the destination in mind. I just may need to alter the components of that plan. So in my world, my way of thinking, having a value creation plan, whether I'm a founder or a PE-backed CEO or a public CEO. Public CEOs live quarter by quarter. Here's the plan for the year, but I'm only as good as my next quarter in a public environment. How am I going to engineer that destination of each of these quarters in a given fiscal year? So planning horizons may change, whether I'm public, private, founder-led, PE-owned. But at the end of the day, they all come back to I have to have a plan. I have to understand. I can't rely on heroics and founder, founder amazing, outcomes because they work 80 hours a week and they make every decision in a company. It's like, in order to build and scale a business large, I'm going to have a system in place. And I talk about this all the time. When I'm a founder, when I'm a small company, what makes me successful is I'm the first chair player in every section of my orchestra. I know everything about the company, and I understand my unit level economics very well. What's the unit level? What's the revenue I can generate at the unit level? What's the cost of that unit level? What's the gross profit? And I'm looking for the happy meal effect. I have to make sure that everything happens identically for every customer in order to keep customers and to build revenue. But the problem with most founders is, as the company scales from startup through the first million, maybe to 10 million, 20 million in revenue, and that's rare enough as it is. There's 34 million small companies in the US, only 7% ever see $1 million in revenue. Of the 7% that do, only 4% of those ever see 10 million. But somewhere above 10 million, between 10 and 30 million, most entrepreneurs tap out. No more bandwidth. They're making every decision in the company. They're not letting go. They're the first chair player in every section of the orchestra. And in order to find the next level of success and smash through their own glass ceiling, they have to learn how to become the conductor of the orchestra. They have to learn how to hire a team and to have other people that are first chair players in every section of the orchestra so that they can focus on conducting, letting go, using metrics, having a plan in place. All of these things are interrelated. And entrepreneurs that can find that second gear to go from control freak to letting go, hiring a team, empowering a team, having a system in place, having a strategic plan in place, using metrics and KPIs to drive an outcome. People who can make that are the people who can bust through that glass ceiling. And really, at that point, they're limitless in terms of growth. If they have good fundamentals in their business, then as they get larger, as they learn how to scale, they become a conductor of a bigger orchestra. It's a bigger stage, but the fundamentals are the same.
Yeah.
So the real struggles are 0 to a million to 10, finding that next gear somewhere between 10 and 30. And then that empowers somebody to really blow through and get to the 100 million or more from a revenue and size perspective.
And you mentioned something interesting, which is letting go. Can you coach people on that? Is that something that people can learn over time?
Yes. In short, yes. Can everyone? No. Unfortunately, there are entrepreneurs. I call it the accidental arrogance of success. So some founders beat the odds. They hit that $1 million in revenue. God bless them. They're the 7%. And then some of those people find their way to 10 plus, and bless them, they're the 4% of the 7% that can get that far. But somewhere in there, this accidental arrogance shows up. Hey, I've arrived. I don't need help. You can't teach me anything. I don't, there's nothing more for me to learn. I've arrived. Look at my business. And so some people cannot get out of their own way. They cannot be helped. They cannot be saved. But there are plenty of other people. And I'd say, especially in today's world, the world is a small place. I have over 100 companies that I'm working with today. They're on 5 continents. So the world has shrunk. And the thirst for knowledge and the quest for knowledge, because of the internet age, has really changed business dynamics over the last 20, 30 years, let alone AI. We're not even touching on AI yet, but just the fact that the world's become a smaller place because of technology, because of the internet. There are a lot of people who are thirsty for knowledge and thirsty for learning. And someone who knows they need help busting through and getting to the next level, those are the people that absolutely can learn, can find solutions to problems. And whether it's through books or podcasts like this one, or it's working with a coach or a mentor or a peer group, people today are more thirsty than ever, I think, and more accepting of that. If I go back to my early career, when, I'm in my 30s and I'm a CEO for the first time, and I think about my own life. I had that accidental arrogance of success. I think we all do. There's a hubris that goes with being successful, at an early age. And somewhere along my path of, finding maturity, I recognized and realized that, hey, there's a lot of people out there who are smarter than me, and I can learn from them. And adopting best practices and hiring great people and inspiring them, and then getting out of the way and letting them run. Somewhere we learn that lesson, or we don't. If we don't, we tap out, our companies stall, we never find the next level of growth. If I look at the 58 companies that I bought, the vast majority of them were run by entrepreneurs who had kind of tapped out. And I'm buying them, putting them together, and I've got a different gear, and I'm getting these companies to a completely different level. But I spend my entire life today. This is my passion now, is teaching others how to succeed, how to do this. And so, yes, absolutely, there's people out there that learn and they find success.
Awesome. Thank you. So, what does good planning look like? The first 90 or 180 days after a PE transaction closes. You mentioned
So,
before looking at the senior executive team, evaluating and all of that, but what's next?
So I do have a way that I like to immerse in a company. So when I'm hired, I'm coming in from the outside. I like to forget everything I ever knew about a company. And I like to sit down and interview and ride along. I might ask HR for a census, employee census. Oh, hey, you have 1,900 service techs. Okay, great. Let's go spend time in the field with service techs. You've got 425 construction workers. Great. Let's go spend time on construction sites. Let's see what these people do for a living. You got 67 salespeople. Great. Let's go ride around with salespeople. Let's meet some customers. Let's see how the sales process works. And so I'm looking for, what is the activity that this company does a lot of? Who are the people? And I go do ride-alongs. I interview them. I ask questions, but I don't have any opinions pre-formulated. I just want to understand, when I'm a CEO and I'm looking at a spreadsheet, I don't want to see numbers of people, and I want to see jobs. I want to have a vision in my head of, there's 1,900 techs on that line of a spreadsheet. Great. Here's the average revenue per tech, or here's the revenue broken down, by that. But I want to see people and jobs and understand, because I've walked in their shoes. So I like to immerse. In your context, someone may have built the company and now they've transitioned, they've sold it, they've been successful. And I would tell you that PE spends 6 months and an inordinate amount of money doing diligence, and learning about the company. But they spend almost no time and no money teaching a founder how to succeed in a PE owned and backed environment. And so here's a statistic that may shock you, but 73% of founders who sell to private equity do not survive the next 5-year hold period. Most are gone within the first 18 months. Is it because they don't know what they're doing? Is it because they're a failure? Is it because they're not intelligent? No, it's because nobody taught them how to go from being lone wolf, responsible for everything, to becoming team player. And I use that analogy because in the world of private equity, being a CEO in a PE backed company, that's business as a professional sport, played at its highest level. And founders who are unprepared, that's why I write my books, is to try to prepare them for that journey. And so typically I want to immerse, learn about the company. I need to evaluate my team on the field. Maybe I just sold the company. Here's a story, true story. I just get done selling a company, a 4 times multiple of invested capital, which in PE speak is a home run. And we did it in 3 years. And after just selling the company and spending time at Pelican Hill with my team, partying our rear ends off, and celebrating success, I then turn around and have to let a senior executive go. Why? Why? Because as I contemplate the journey from where we were at that point in time, so think of it in a sports analogy. I just won the Super Bowl. We just are celebrating the Super Bowl win. And now I'm thinking about the next season. And I'm thinking about the team I have on the field and the fact that I have some talent gaps in certain positions that, although they were able to win a championship at the size level we were at, knowing where we're headed over the next 4 or 5 years and the work that needs to be done, I'm turning over people on a team that just won a championship as the manager of the team because I need different talent on the field for the next challenge that's coming. So I'm evaluating those people, but even if I just won the championship, I'm still evaluating these people to see, can we get to the next level? But then comes the value creation planning. Where am I at? What is my revenue? What is my earnings? What's my shareholder value today? And where do I need to get in order to have a good outcome, over that next period, which in PE speak is generally 5 years. With founder-led companies, I get them doing value creation planning in 1-year increments with a 3-year strategic plan. So aspirationally, here's where we are. Here's where we want to be in 3 years. Let's break that down into 3 1-year plans. What is the activity that's going to take place in the next 12 months that sets up the second year, sets up the third year, so that in 3 years we can achieve this goal and objective that we've laid out. In the world of PE, we do 5-year strategic planning, 5-year value creation plans, because that's the typical hold period. We never see years 3, 4, and 5 because every year we're recasting the plan. How far did we actually get? Let's now recast the 5-year plan. And so at year 1, it's a new 5-year plan. Year 2, it's an updated 5-year plan. Year 3, there's always 5 years hanging out there. I don't just plan once and then spend the rest of my that plan. I'm updating that plan every year. So I teach entrepreneurs who are famous for not planning at all. A lot of companies I work with, they may have $50 to $100 million in revenue, and they have no strategic plan. They have no budget really to speak of in place. They may have some process that they go through every year, but they're really not thinking strategically. They're not thinking about a journey ahead. They're just managing. I call it riding the wave. They're riding the wave. They're riding the wave of expansion in a good market. They're hunkering down in a recession, and they're not really effectively putting a strategic plan in place. So for me, it's call it immerse and learn the business, do a bunch of interviews, ride-alongs, spend, call it the first 90 to 180 days evaluating the team on the field. I want to have any changes made, if possible, within my first year. I have a short window, generally 5 years. By the end of the first year, I want a value creation plan in place. I want a team on the field, right seats, right bus. From there, we look at having a strategic plan is one thing, but a strategic plan is no good if someone doesn't own the actual initiatives that drive the individual strategies that are driving growth or margin improvement, or mergers and acquisitions. And so I move very quickly to, I've got the right team on the bus. Now we have a strategic plan. Hopefully they've helped me build that. I haven't built it in a vacuum. I've built it with their input. And now it's who in the company owns making this work happen. And then what is the measuring systems that we're going to have in place that let us know if we're winning or losing? Mm-hmm. And then what's the cadence of management that I'm going to use to be reviewing all of these different segments of the strategic plan to make sure that we're on track? Hey, the economy threw us a curveball. Hey, there's a war, there's a pandemic, something's changed, and the plan's not working as we envisioned. What adjustments are going to be made? What's my cadence that's going to allow me to detect those changes, detect when something is working or detect when it's not, and modification needs to be made? So it's really it's actually quite simple when you think about it, but so few companies actually do it. I need to understand my business inside and out. I need to determine if I have the right leadership team in place. And a part of that is incentives. We haven't gotten there yet too, but I also want to make sure that I've got the proper incentives in place, a long-term value creation plan, and then people who own the execution of that plan, measuring systems so I know if I'm winning or losing, and then a cadence of managing the process. And I go back to this playbook every time. Every time I'm running a business, I don't care what industry, I don't care what the company does. My plan is going to have the same elements.
Mm-hmm. And do you interact with integrated business planning or IBP or SNOP within an organization? Like from the 58 acquisitions that you managed, did you find planning teams in place, and how did you interact with them to drive the most value?
So I found in most cases no planning teams in place at all, a total vacuum. As I said, a lot of entrepreneurs. So I may have started with a platform company that was a little bit larger, and then the acquisitions I'm making are smaller relative to the platform that I'm running. But typically those companies that I'm buying, they had, the 58 companies were probably between 10 and 30 million in revenue. They were probably earning $1 million to $4 million of EBITDA, and so they had varying levels of sophistication, but most of them would have had no formal continuous improvement process in place, no system that was being used, no people that were there. A part of me creating a value create, when I'm putting a value creation plan together, it's also when I'm talking about who within the company is going to own driving these individual initiatives, recognizing that we have to keep the trains running on time and we have to delight the current customer base. We can't have any erosion at all. So I have people that are engaged in bending the growth curve, making growth happen. But the majority of my employees are going to be engaged in keeping the trains running on time. Yeah. And so oftentimes, especially in a buy and build, if I'm buying companies, a piece of that human capital plan includes bringing in project managers or people with a Lean Sigma or a Six Sigma background, whatever is appropriate for the industry and the type of company that I'm running. People to work on the business, not in the business. So they're not responsible at all for the trains running on time. Their job is continuous improvement. How are we going to, because I am going to double or triple or quadruple the size of that business in a very short period of time, whether it be organically or margin improvement or M&A or some combination of all, the trains are going to get stressed. So if I double the size of this company, where will it break? Why will the train stop running on time? Where are the bottlenecks? Where are the process deficiencies? What are the things today that barely work that if I stress the company with growth are going to absolutely fail? Let's figure out, where those process bottlenecks are. Let's design for better throughput, better efficiency. Let's start making the investments that we need in systems, and in any internal, whether it's a retooling of a plant or just designing a process, bringing technology to bear to eliminate manual tasks that are gonna eat us alive later on with growth. And in order to do that, I need people. And so I can do it one of two ways, and I generally do both. But if I'm starting out, I might need some surge capacity. And so I'll go to some trusted consulting groups and say, hey, I have 1,900 service techs doing 1 million service calls a year. I need some quick analysis of this giant process that I'm doing 1 million times a year. Let's look for the bottlenecks. Let's redesign. Let's find technology gaps. Let's work on something I do a lot of, because if I can find a 5% improvement there across 1 million service calls, boy, that's going to have some big bottom line impact. And so when I don't have the team internally, I'm bringing in surge capacity, which are consultants who can help me analyze different pieces of my business. And I may have multiple consulting groups attacking different things at the same time within that business. And I'm not pulling in my resources who are keeping the trains running on time. I'm relying on some outsourced capacity to help me do some of this work so that I can keep the trains running on time. And then as I'm getting some initial traction, then again, these companies were turnarounds for me. So I'm bringing in some people to help. When I start to see traction, then I can start making some investments and start hiring some people internally who can then own, continuous improvement, and or bringing in project managers to become integration managers or to help with large scale implementations of new technology, and or integration, so that again, 90% of my employees can keep the trains running on time. They're working in the business, but I have a group of people now that I've developed between outsource and insource, new people hired who are working on the business to make it more efficient.
Got it. Thank you. And so oftentimes boards and sponsors are pushing for speed. How do you usually protect the quality of strategic planning decisions?
So while you're correct in that there is a sense of urgency always, I'm going to go back to, if I'm a founder selling my business, it's not just about price. It's not just about getting the largest first bite of the apple that I can. It's also about picking the right partner. And I would say that, as we move higher up the food chain, larger PE firms tend to be much more sophisticated at this and at understanding that early in a hold period, if there is to be significant investment made, this is when we want to make it. We want to make it early. We want to gear up for growth. And that's the hockey stick effect of, I'm making investments. My earnings might actually be dropping, but I'm not selling tomorrow. I have 5 years. And then I want to see those investments leading to, a new high and a new trajectory for earnings, and for growth of revenue. And so I have to have some level of patience. And I find a lack of patience when I get lower and lower and lower into the middle market. So when you're getting down to really small companies with really small PE firms or unsophisticated owners, I'm going to call them, because in the world of PE, there's sophisticated, there's unsophisticated, there's great firms, and there's some pretty crappy firms out there. So picking your partner founders, that's an important piece of this. But having said that, there has to be some level of understanding. And when investors cross the line and try to become operators, things usually move south. And they're not doing it for any other reason than they have that sense of urgency and the founder's not delivering or the leadership team is not delivering. And so, if they're not executing, if they're not delivering the results, then you're going to get help. And you don't want help if you're an operator. But what I find is that when we have properly aligned teams, when there is good teamwork, amongst this group of people at the board level, then generally there is some understanding. And so I'd say for the people on the other side of the table, not the operators, but on the ownership side, on the board side, we have to ask ourselves, I serve on a lot of boards today. We have to ask ourselves a question. Is our failure to hit numbers due to external macroeconomic conditions, whether we planned or not? Pandemic hit, that changed the trajectory of a lot of companies. So is it because of some macroeconomic factor, or is it management's failure to execute? If it's management's failure to execute, I have to question, do I have the right team on the field if we can't get them back on direction, with some help from the board and or outside consultants and advisors that we bring in to help. If there's a macroeconomic condition, then we're in this together. We need to rethink that strategic plan, that value creation plan. It has to adjust. But as a sophisticated owner or investor, I need to understand the difference. When is management failing to execute versus when is a macroeconomic condition changed, and impacted the way the business is performing? And if I, as an investor or a board member, can separate those two issues, I'll eliminate a lot of the stress that can be created when the numbers aren't good and the board's stepping in and they're hiring old guys like me to be, operators, operating partners. And we're the fly by night guys. We come in for a board meeting, we read a report, we issue some edicts, from our wisdom, and then we blow back out of town. It's like, and that CEO is living it every day. And so to be collaborative, I think that's the biggest area where we need to be able to understand and separate management's failure to execute or management disconnecting. Keep in mind, I said 73% of founders don't make it 5 years. There is some percentage of that, where these people just became very wealthy and they check out. I don't want to work very hard. You want me to work harder than I've ever worked before. And I just put 30 million, 50 million, 100 million in the bank, and you want me to work hard. I don't want to work hard anymore. I want to relax. Well, your investors haven't had a payday yet, and they want you to work harder than you've ever worked before in your life. And that's why I call it business as a professional sport. Kobe Bryant, Michael Jordan, these guys may have been the best basketball players ever, but they still showed up to practice and they still put in the work. Because if you want to win a championship, you have to work. It doesn't get handed to you. So I think these are the nuanced kind of areas, the things I think of, when we talk about the failure of a plan or the disconnect between leadership, management, and a board.
Yeah. And you obviously have built many high-performing cultures repeatedly. How does strategic planning reinforce accountability without crushing the entrepreneurial spirit?
Yeah. So great question. Strategic plans, I talked about being a pilot. If I know where I'm going, I can plan and I can create all the components I need for a successful flight. Well, if I'm building a company and I'm growing from a certain size, from one size to another, people is a large component of this. So companies don't grow because I will it or wish it. I start by building a very strong culture. I want people to work really hard. In order for them to work really hard, I need to build some kind of a shared alignment. And I do that with, as a part of the value creation planning, I usually put in place a long-term incentive plan. So I am going to reward those people that help us achieve this plan, and I'm going to make them a part of the success. So they have we get our salaries. I have to pay a fair market wage or I'll lose talent. We have our annual bonus plan, and that's our reward for working hard in the year. But I also want to have the long-term incentive plan, which helps me accomplish that multi-year strategic plan. And it lets those people participate in the wealth creation that's taking place. When I have those things, I can be very transparent as a CEO and talk openly about revenue growth, earnings growth, and what it means to each of the people. A growing company creates opportunities for line employees to see promotions. And in the world of private equity today, it's not uncommon to see line employees also participating in some of the upside of the value creation plan when it's hit. I have to have a measuring system in place to know if I'm winning or losing. That measuring system, those key performance indicators, those are also there to help me with the process of managing people, managing success. Some of my metrics might include things like how many days does it take me to hire for an open position? What is the average tenure of my workforce? What's the net promoter score from an employee perspective? My employees like being here. What do they think of leadership? What do they think of the direction of the company? I'm giving them a voice. I'm connecting from the ground all the way up to the top, making sure that I've got a consistent message, that the why, the magnetic north is identified, the why we're doing this is identified. They're sharing in the success and the outcome, and they know how I'm keeping score. And so they, at the employee level, I may have 3 or 4 metrics for every job in the company. And anybody that comes into the company is going to know what success looks like. And they're going to see, in a peer group, how they're performing against the group and who's on top and who's on bottom. And I'm going to use metrics as a part of a strong culture to reinforce the fact that, hey, we can't mail it in. We have a destination and a timeline that we have to hit, and we're measuring that success. And I'm teaching them how to think differently and how to turn success into what I call napkin math. If I have a sales team and a sales team has a number, I don't even have to talk about numbers. I can simply say that if the average value of a customer is $100,000 and I want to add $1 million in revenue this year organically, I need 10 customers. Well, how many leads do I need to put out how many proposals at a given win rate leads to me adding those 10 customers? and I'm just making up easy math so that it's simple to do. Maybe I need 100 leads to put out 30 proposals to win 10 large contracts. So I've got a 10% close rate. Well, now I can measure napkin math every week. Am I getting enough leads? Am I putting out enough proposals? How's my win rate? If my leads are down, I have to turn up my close rate. If my leads are up, I can expect at the current close rate more wins. And so I can become very predictive in what's going to happen in terms of that revenue growth target, but I'm not measuring revenue.
Right.
Marketing, we're looking for number of leads. Sales, I'm looking for a certain number of proposals and then a certain close rate. And so I can turn success into something that any line employee in any department can understand. And
Yeah.
I drive the behavior that leads to the success. And if I've got the right behavior daily, I can win a week. And if I've got it weekly, I can make a month. And if I've got it monthly, I can make a quarter, and the quarters deliver the year. The years deliver the strategic plan. So success doesn't have to be difficult, but employees have to understand what the behavior is that we're looking for and what the activities are that lead to the success.
Absolutely. And sometimes there might be a need for calibrating a little bit that equation, because the average time it takes from proposal generation until proposal closure, even if you have the same win rate, might need to be shrunk a little bit. And that's something that,
Sure.
yeah. So it's always a good triangulation, balancing the win rate, the proposal value, but then also how long does it take them to close that business? And
Sure.
this
And,
has been an
and when I'm
amazing,
thinking about price,
yeah,
price is one of my most important value drivers because every penny I get in price falls right to the bottom line. It's so if I'm a company with a 10% net profit, and I raise my prices 5%, that's a 50% increase in profitability for
exactly.
only a 5% increase in price. Well, what about the sales team that says, hey, we can't raise prices. If we do, we won't be able to win the business. So I can start doing A/B testing. I've got, 5 sales reps. Every time these 4 put it out, we'll do it the same way we've always priced it. Whenever this person does it, we'll price it the same way. Then we'll add 5%. Then we'll monitor close rates. And if the close rates don't change, now I raise prices everywhere. And so there's all of these different activities and things that we can do. We have to be very willing to experiment when we're
Yeah.
building a business and trying to find maximum success. I don't, most companies price, just not to go off on too much of a tangent, but the worst way in the world to price is to figure out what's my cost and what do I want my margin to be. And then I put out my bid. That gives away all price elasticity to the customer. And unless I'm a charity, I don't want to give away price elasticity to the customer. I want it for me. I have to find the place where if I add one more dollar to my bid, I lose. They say no. And then I back off that dollar and I'm at the right optimal price, which is constantly changing. So, so many, nuanced ways to manage success, and none of them are difficult. None of them. You
Yeah.
do not have to be a literal rocket scientist or a PhD in order to engineer, strong growth rates in a business. It's quite
Absolutely.
simple, but it does require a plan. If I went off camera for 15 seconds, I could bring back 2 strategic plans from the last 2 companies that I ran, and you'd find that they're this thick. They're it's like it starts off with a couple page high level strategic value creation plan, but each one of those levers of growth gets turned into initiatives. Initiatives have people assigned. They have activities assigned. There's measuring systems, and it gets very detailed very quickly. And then I always am reducing, everything to a napkin math so that line employees who don't have necessarily a financial acumen or a business acumen, doesn't matter. They just need to know what activities do they need to do at
Yeah.
what numbers and at what success rates. And if I put all of that together for all the jobs and all the companies, it takes me to my promised land destination, just by default.
Yeah.
So always, it's always fascinating to me that, when I am teaching and working with leadership teams, the things that I'm teaching are actually quite basic, but yet so few companies actually do them.
Yeah. The rules of the game are the same always. across industries.
Never change. Yeah, they
And
never
it's
change.
just how you
Sometimes
apply
my
them.
levers,
Yes,
yeah. So
exactly right.
if I have 8 levers, I might set them a little bit differently in a different industry, or company, but they are the same.
But the
It's the
discipline, I
same thing.
think, is what you bring to the table, and the discipline of how do you customize those rules to apply and to drive that value creation plan the fastest is definitely what makes or break a business. So
Absolutely.
Adam, I am so thankful for the time you have given us today. Thank you so much for joining us. And if you had one closing remarks, not to the CEOs, but to the emerging leaders, what would you tell them?
Get up every morning, look in the mirror, and ask yourself one question: why not me? Why can't I be the next vice president of this or chief of that, or CEO? Why not you? I hang out with a lot of billionaires and a lot of very sophisticated, well to do people who found very high levels of success. And the thing that always amazes me is how uniquely ordinary they actually are. And so the difference between a millionaire and a billionaire is a millionaire knows how to make money. A billionaire went all in on something and hit, and found success at a very high level. And I think, the higher your net worth or the more money that you make, you realize that you're the same person that you were 20 years ago, that there's nothing necessarily special about you. And so it starts with a belief that you can climb the corporate ladder. You're talking to a guy who started his career, as a private in the United States Army right out of high school, who looked up and saw bubble gum on the bottom of somebody else's shoe. I started my corporate career in a truck, in a service truck as a technician. I've held every job on an org chart that a person can hold, from worker bee line employee at the lowest level to CEO. And it always started with the belief, in yourself. Why not you? You can do this. You can find success. You just have to apply yourself, not be afraid to try. And if you get knocked down, get back up. We learn our best lessons when we make mistakes. If a person never makes mistakes and all they find is success, they don't know what adversity looks like. And the first time they encounter it, they don't know what to do with it. Don't be afraid of making mistakes. Be afraid of not trying. Be afraid of waking up in 30 years and saying, I wish I would have. I wish I should have. I could have, and I never tried. Get knocked down, get back up, get back in the fight, believe in yourself, climb the corporate ladder. You can do this. And it starts with believing that you can do this.
Awesome. Thank you so very much. And I'm looking forward to hosting you again and again on the podcast if you would be willing to contribute. Truly appreciate your time, Adam.
Happy to come back.
Thank you, sir. Have a great day.
You too. Take care.